Many people think that crypto has no real utility and that prices depend purely on speculation. But that couldn't be further from the truth. Dozens of crypto projects are generating billions in fees, and recently a load of them announced that they'll use that revenue to buy back their own tokens. That's not just utility, that is a built-in catalyst for potential price appreciation. That's why in today's video we're breaking down which projects are planning on buying back their tokens and what that could mean for those tokens once those buybacks kick in. My name is Guy, and you're watching The Coin Bureau. I'll start by saying, though, that I'm not a financial advisor and nothing in this video is financial or investment advice. It's educational content intended to inform you about a handful of crypto projects planning to do buybacks. If that sounds good, prove it by punching that like button, and let's get into it. Now, the first crypto project planning to do buybacks is Uniswap. For those unfamiliar, Uniswap was founded by Hayden Adams and it launched in November 2018. Uniswap has since become the world's biggest decentralized exchange, with $4.1 billion in total value locked at the time of shooting. More importantly, it's generated over $5.2 billion in cumulative fee revenue. On the 10th of November this year, Adams put forward a fee switch proposal called unification, which would use a portion of protocol fees to buy back and burn the Uni token. So how exactly would this work? Well, the first thing to know is that this fee switch could be gradually rolled out. It would start with Uniswap's V2 pools and select V3 pools that cover 80 to 95% of liquidity provision fees on the Ethereum mainnet. After that, the fee switch would be activated on Ethereum's Layer 2s, other Layer 1s, Uniswap v4, its latest version, and Uniswap X, an auction-based trading protocol that aggregates on-chain and off-chain liquidity. Currently, Uniswap v2 pools charge a 0.3% fee. Under the unification plan, 0.05% of this fee would be used to buy and burn Uni. For Uniswap v3, protocol fees would operate differently due to its multiple fee tiers. Basically, pools with fees between 0.01% and 0.05% would allocate 1/4 of their fees to buybacks and burns, while pools with fees between 0.3% and 1% would allocate 1/6 of their fees to buybacks and burns. And that's not all. In case you didn't know, Uniswap has its own chain now. It's called Unichain, and it's also been generating fees. In the 9 months since Unichain's launch, it's processed around $100 billion in annualized DEX volume and $7.5 million in annualized sequencer fees. After the change, these sequencer fees would go to burning Uni, after deducting Layer 1 data costs and a 15% fee to Optimism for its role in the superchain ecosystem. Topic for another time. Anyways, on top of all these fees, there are also fees from Uniswap's hooks, which are essentially plugins introduced in v4 that turn Uniswap into an on-chain liquidity aggregator. Under the fee switch proposal, a portion of these fees would also go towards burning Uni tokens. And if that wasn't enough, Adams also proposed burning 100 million Uni from the Uniswap treasury. This is because this is roughly the amount of Uni that would have been burned if the fee switch had been active since the Uni token's launch. Now this is huge, considering Uni's circulating supply is 630 million. The treasury burn alone would cut Uni's supply by over 15%. Taken together then, this works out as a 2.5% reduction in Uni's supply every single year. And as basic economics dictate, a smaller supply with the same or increasing demand means the price goes up. So then this begs the question of what this could all mean for Uni's price. Well, as bullish as the fee switch is, it's important to remember that it will be a gradual rollout. Some analysts suggest Uni could stabilize between $7 and $12 in the short term, likely through the remainder of 2025. By 2026, as the fee switch is activated across the protocol, many are predicting Uni could reach $15 to $20, assuming we're not in a bear market by then, of course. And if you're looking to buy Uni, or indeed any of the other cryptos we'll be mentioning in today's video, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on some of the best crypto exchanges. Just hit the link in the description or scan this QR code, which will take you to the deals page. There you'll see all of our offers across a range of exchange partners. Simply click one of these Sign Up Now buttons and that should take you right to the deal. Now, these deals won't be around forever though, so take advantage of them while you can using the link in the description below or by scanning the QR code on screen now. Okay, the second crypto planning on doing buybacks is Lido Finance. For those unfamiliar, Lido is a liquid staking protocol for Ethereum. It was founded by Konstantin Lomashuk, Vasily Shapovalov, and Jordan Fish, better known as Kobe. Lido Finance launched in December 2020, and since that time it has dominated the liquid staking market with over $26 billion in total value locked and more than $2.8 billion in total fees generated at the time of shooting. On the 11th of November this year, Stakehouse Financial, which merged with the Lido DAO to form the Lido Finance Operations Team, proposed an automated buyback mechanism for LDO. Now, the proposal came the day after Uniswap's announcement, but the two plans are very different. Basically, LDO buybacks would be done through something called NEST, which stands for Network Economic Support Tokenomics. You can think of NEST as a programmable trading system. The plan is for a buyback mechanism to trigger automatically when two conditions are met: when ETH's price exceeds $3,000 and Lido's annualized revenue hits $40 million. Each time NEST is triggered, it would automatically buy 350,000 LDO tokens. However, there are a few limits, including a $10 million buyback cap every 12 months and a 2% price impact cap to prevent major price fluctuations. And we should note that the proposal doesn't specify what percentage of Lido's protocol fees would go towards LDO buybacks, although some analysts estimate that 10% of the protocol's staking rewards could be used to fund them. Anyway, alongside the buyback mechanism, Stakehouse also proposed a new Uniswap V2-style liquidity pool, which would be kickstarted with 200,000 LDO and 50 WST ETH, the wrapped version of Lido's ST ETH. The aim of the pool would be to complement the LDO buybacks and boost the everyday use of LDO across dexes like Uniswap. Assuming the proposal passes, which seems highly likely, buybacks would start in Q1 2026. For context, spending the full $10 million would accumulate about 14 million LDO at today's prices. With LDO's circulating supply currently sitting at 890 million, that works out to roughly 1.6% of the supply, which is not too shabby. However, there is a caveat. Unlike Uniswap, which burns bought-back tokens, Lido plans to add its LDO to the liquidity pool mentioned earlier. So while this technically reduces LDO circulation, the tokens still exist on-chain. In other words, the supply doesn't really change. Even so, this is still a bullish development that could boost LDO's price. In the short term, LDO faces key resistance around $1.45. With the right market conditions, though, that could break above this level, at which point it can set its sights on the next resistance zone at around $2. Notably, though, this is a conservative estimate, and that's simply because LDO could benefit massively from staked Ethereum ETFs expected to launch soon. These could bring huge institutional capital, meaning lots of ETH will likely be staked, some of which will go through Lido, the biggest staking protocol in crypto. Naturally, LDO's price would likely benefit from this influx of protocol activity and also the hype related to the headlines. Now, the third crypto planning on doing buybacks is Ethena, a decentralized stablecoin protocol on Ethereum. Ethena was launched in February 2024, and its USDE stablecoin hit a $1 billion market cap in just 23 days. Impressive stuff. The Ethena protocol has $7.8 billion in total value locked and has generated $609 million in fee revenue at the time of shooting. Now, here is where things get interesting. In November last year, the Ethena Foundation proposed a fee switch to redirect part of Ethena's protocol fees towards buying back ENA. Before this could happen, though, 3 success criteria had to be met. First, USDE must reach a circulating supply of more than $6 billion. Well, at the time of shooting, USDE has a circulating supply of $7.6 billion. First criterion, check. Second, Ethena's lifetime cumulative protocol revenue needed to exceed $250 million. As I record this, it's at almost $600 million, according to data from Token Terminal. Second criterion, check. And third, USDE must be integrated with 4 of the top 5 centralized derivatives exchanges. For those wondering, these are Binance, Bybit, OKX, Gate, and BitGet. USDE is listed on 4, with OKX being the only exception. So, third criterion, check. So, the fee switch has been activated then, right? Well, no. Even though the Athena Foundation confirmed in mid-September that the success metrics were met, Athena's risk committee still needs to approve the final implementation details, including exactly how the fees will be allocated. Once finalized, though, the fee switch will be proposed and ENA holders will be asked to vote to approve the proposal. For what it's worth, though, Athena founder Guy Young has said the fee switch is a top priority, suggesting it could be finalized, well, any day now. When that happens, things could look very bullish for ENA. Holders of SENA, the staked ENA token, could receive anywhere between 4.5% and 15% of Athena's revenue, providing a strong incentive that's likely to boost buying pressure and reduce selling pressure. According to Arthur Hayes, the fee switch could unlock $500 million in buyback potential. At today's prices, that's about 1.8 billion tokens, or 12% of the supply. Not surprisingly, the fee switch is highly anticipated and is expected to be bullish for ENA. If it can break above a key resistance level at around 40 cents, then some analysts believe it could reach even $1 before year end. A buyback mechanism being activated could be the catalyst. And full disclosure, folks, I hold ENA in my personal portfolio, by the way. Now, the fourth crypto planning on doing buybacks is Arbitrum, the largest layer 2 on Ethereum. Arbitrum was soft launched by Off-Chain Labs in May 2021 and had roughly 300 dApps working on it within the first 2 months alone. Its mainnet, Arbitrum 1, launched in August 2021. Now, Arbitrum has around $15 billion in total value locked and has generated over $160 million in fees. Back in March, Off-Chain Labs, the foundation behind Arbitrum, announced that it was planning to roll out strategic buybacks of the ARB token, which would be added to the company's treasury. Notably, the announcement came after ARB's price had tanked by around 85% in just 3 months, and right before more than 92 million ARB tokens were unlocked between March and April. If that wasn't suspect enough, Off-Chain Labs didn't disclose any specific details in their announcement, nothing about how much ARB they planned to buy back or how much they were willing to spend. Moreover, there have been no updates from Off-Chain Labs about any completed buybacks or any buyback plans since the announcement back in March. The good news, though, is that with so many projects racing to buy back their own tokens, it's possible that these plans could be put back on the table, which would theoretically be bullish for ARB's price. Now, of course, the impact depends on the details, as in how much ARB is bought back. For now, though, ARB faces a key resistance zone between 47 and 62 cents. Breaking above this could allow it to target around $1.15, at least in the near term. And more full disclosure, I also hold ARB in my portfolio. Now, as you might have noticed, it looks like many large crypto projects have started announcing buyback mechanisms, presumably due to the poor market conditions we find ourselves in. And yet, for many, their prices have continued to fall. So this begs the question of whether buybacks are really as bullish as people think. Well, from our perspective, the impact of the buybacks depends on several factors. Are the plans transparent? Is there enough demand without them? Do purchases represent a meaningful share of circulating supply? Are the tokens held long-term in a treasury or by the foundation, which could sell them for future development? And perhaps most importantly, is there a burn mechanism in place? After all, buybacks on their own are all well and good, but they also present a risk of huge amounts of tokens suddenly hitting the market again further down the line. The only way to truly prevent this risk is to burn them and remove them from circulation permanently. Even without token burns, though, crypto buybacks are bullish overall, and the trend we're currently seeing will likely continue, especially as market conditions continue to push project values down. When investors feel extreme fear, these initiatives help projects to stay relevant. Traders may be more inclined to invest in projects with buybacks, hoping to hedge their portfolios. In the long run, that should, in theory, be good for those projects with strong businesses and fundamentals. And with so many red candles out there, it certainly would be nice to see the occasional green one once in a while. All right, folks, that's quite enough from me for today, but if you're wondering what happens next as crypto prices collapse, then check out the video right here. And if you want to learn more about the fear